The one and only Jim Brogan joins me on the broadcast. Jim, as always, a pleasure to speak with you.
Good afternoon, Hallerin. How are things with you?
Great. Jim is offering a wonderful class at Pellissippi State Hardin Valley on August the 20th. It's called Retirement Planning for Retirement, or Income Planning for Retirement. Let's start there by just having you talk about people really enjoy these educational encounters. Let's talk about that first.
Yeah, that's so when we started doing that income planning class, it's just a one-night class, Hallerin, for 2 hours. And I did it because it's been very, very well received, because I do think how we handle retirement income is probably the most overlooked and also one of the most important areas in retirement planning. Not just how much income you can draw from your investments, but where do you draw it from? What's the tax efficiency? How do you structure your investments to support that income for stability in the short term, growth in the long term for inflation, all of those things that can come, tax implications, I think I mentioned that. So we decided to do just this one-night class at Pellissippi State Hardin Valley, and it's been very, very well received. We've been doing that for I think we've done it 3 times.
Yeah, I know it's been a wonderful class for a lot of people. Where do people go if they want to sign up, register for that?
They can go to PellissippiRetirementIncome.com. So PellissippiRetirementIncome.com. They can download a syllabus, and they can click to register with Pellissippi State.
All right, thanks. Now let's get into what's happening in the world of finance. Everybody's talking about the election and how an election year, a presidential election year, would or could affect their investments. You got a crystal ball over there. What do you see?
Yeah, I got a crystal ball right here in my boardroom, Hallerin, and the thing just does not work.
Turn it off, turn it back on.
I think it's missing a battery or something. I can't find the battery compartment. But no, this has been the number one question I've been getting probably since January, February. And then, of course, the last month, what a crazy month. It's just ramped up to a whole other level. Now, I will say overall, the way you first phrased that question, markets usually are up in election years, but, if you look at it, markets are usually up most years. So, it's a loose correlation. The biggest thing right now is no matter which side of the aisle you stand on, everybody's worried. Everybody's worried about the future of the country, what's going to happen. That type of stuff in the short term can certainly drive some investment volatility and some spikes in the market. However, all any of that is, Hallerin, in my view, is short-term reactions to what investors perceive may happen. The reality is, and we've gone back all the way to George Washington and studied election cycles, and the reality is the underlying economic realities of those economies is really what drives things in a 4-year presidential term more than anything else. Now, can policies that are implemented make an impact? Absolutely. But be careful with that, because I think the investors, for the most part, think, then the reason markets had been good of late is kind of thinking that Trump would win and there'd be less regulation, less tax, probably the extension of the tax cuts. But, that's not always what happens in terms of the realities of what policies are implemented and how that affects the economy. So I would be very, very careful about worrying too much about how the stock market may affect the election affect your stock market. In the short term, markets are just unpredictable.
Yeah,
we just don't know what might happen.
They're very emotional in the short term. But if the underlying investments have good fundamentals, and you've staged them in such a way that you've got protected income, and then you've got more aggressive investments, that portfolio design is really, and talking to a person like yourself, kind of keeps your powder dry. So the stock market hit another record, and nobody noticed it because of all the political stuff that's going on. But did we cross 40,000?
It's kind of crazy, isn't it? The most unusual thing about the current stock market highs is we continue to hit these highs in a period of immediately following very, very aggressive rate increases from the Federal Reserve. And typically we haven't seen the fourth stage of that cycle, which is for the economy to slow down. So, it's been kind of unexpected.
Can we keep it up?
But again, it just goes to yes, it can always be kept up. Now, you had a very astute observation a minute ago, Hallerin, when you said that in the long term the fundamentals win, and I think that's right. So when and I think that's the core message I really want to relay today, because in the short term, I think a small pullback in the market would probably be healthy long term for the market. Is that going to happen between now and the end of the year? I don't know. I think it may, but we don't know that. But markets in the short term, if I have $20,000 that I need to use to trade my car and buy a new car, Hallerin, that $20,000 should not be invested in the stock market, and I'm going to liquidate in 3 months because I have no idea where the market will be. The market's at all-time highs or near all-time highs. Harvest it now, and I know I got that money for me. I'm not going to sell it when it's on a dip. And that's so critically important in wealth management, is that you don't have to sell your investments on a big dip to pay for things. It's okay to sell and reinvest on a dip, but you never want to sell it and spend it. And so when you talk about where might the market be in October, November, December, it's really kind of a crapshoot. Those market risk investments should be invested for 5-6 years from now, not 5-6 months from now.
Let's talk about the Fed, and let's talk about interest rates. I was watching an interview. Jerome Powell was talking to David Rubenstein, and he was asking him about the Fed, whether or not they were going to raise rates. And Powell started talking about, once again, the fundamentals of our economy. I know we're pacing, inflation's at 2.8%, or inflation is around 3%. Growth is around 2.8%. There's a gap, and he was asking him about whether or not he would raise rates. Powell said that the Fed has two jobs: price stability and then full employment. And he said, we try not to turn the dials too much, because if you turn the dials too much, after a while, you lose the ability to correct an overheating economy or boost an underperforming economy. And so he said, we're going to lay back and wait for more data. What's going on here, and what about this gap, and what about interest rates?
Very wise words. The Fed has a dual mandate. You hit on both of them. The reality is unemployment is still under 4%. And I believe pretty strongly, Hallerin, that based on what we know today, the biggest economic risk we have right now would be another uptick in inflation. And Jerome Powell has been very patient with waiting on the data before he would start decreasing interest rates. I do think an interest rate increase is probably off the table the rest of this year unless, interest rates were to spike back up. But there's now speculation that there might be 3 rate cuts by the end of the year. I think that's probably not correct either. So I expect there might be 1 rate cut by the end of the year, maybe 2. But I think Jerome Powell has taken the right stance because, don't get me wrong, the Fed has done a lot to contribute to some of the inflationary issues we have today, back over the last 15 years. But he's been taking a
patient approach.
He has.
All right, couple of quick questions before we wrap. Typical person, when I was growing up, they worked at the plant and then they got a gold watch. 40 years in, gold watch, pension. That was it. Now, a person will work 8 jobs over the course of a career, which means you may have 8 different 401ks, Roths, whatever. What do you do with all those different retirement accounts as you're starting to approach retirement?
I have a statement. I have an old statement that I use. If you're not at your old employer, why is your money? Now, we don't want to go too far with that. I think the thing you really have to look at is in an employer plan like a 401k, you typically are just going to have limited investment options. And that means that limits your ability to invest for success. It also limits your ability to control fees and costs. An IRA is typically a better platform to be able to do all those things. Plus, more and more people as they get older want to simplify their lives. And so when you roll into IRAs, you can consolidate accounts, and you can take 5 401ks and consolidate them into one IRA. Now, I want to be careful with that because, again, you've got to look at each 401k plan and look at what are the options, what are the costs, what are the fees, and make an educated and informed decision. But as a rule, I have found as people age, they do want to take control of those opportunities a little bit better, and they want to consolidate and simplify.
If you could give us one tip as we are going into this election season, what is it?
Don't let your politics affect your investment and financial plan, because over time, the data says it hasn't had a big impact over time. That's the key. And when we invest and take risk, we're doing it for at least several years. So, unless you're a day trader, which I don't believe in that either, don't let your politics affect your investment plan.
By the way, you can go to PellissippiRetirementIncome.com to sign up for Jim's next class, which is coming up on August the 20th, Income Planning for Retirement. You can listen to Jim on Saturday mornings. Thanks for being on the broadcast today.
Thank you, Hallerin.